Morning, morning crew. Everyone, how are we going? Daylight savings, hey? How much I dislike daylight savings. I don't know about you. As a Queenslander, it's not much fun. The rest of the world changes times and Queensland's left behind. Well, I don't know. Queensland's a bit like that. Doesn't make any sense to me. Why not just use Southeast Queensland, stays on it, and the rest of Queensland changes. Yeah, in the southern states, it's fantastic. I remember living in Sydney and the daylight savings was awesome, having a few hours in the evening to get out and about, that's for sure. Right now, it's annoying me. But anyway, Facebook was down yesterday, team. Facebook was down. The big giant was down. Couldn't come live to you, and Monday was a public holiday for me here in Queensland, so had a little bit of a bit of time out. And I hope you all are awesome and well, wherever you are. Well, yeah, the cows don't know when to come home, Christopher, and my blinds will fade. That's right. Yeah, for sure. Yeah, I'd prefer to live in New South Wales or Victoria in the daylight savings times anyway. Awesome. Well, listen, I hope you're all awesome and well. If anyone's new, I know this is a kind of a new time for the southern states. It's sort of 8:07 now, 9:07 down there. You know, maybe many of you guys are at work or whatever's going on, but, we'll roll with it. If you haven't met me before, if you're new, you're popping by. Jason Witten's my name. Each morning, get together with a few crazy crew, like a lot on here right now, and we talk about property investing, wealth, going the distance, whatever it might be. When it comes to buying and owning real estate, we've got a few sayings around here. Buy well, never sell. And this thing's a marathon, not a sprint. You've got to take time. You've got to commit to this gig, which is property investing. But today I wanted to just touch base on a few things. So maybe just a little bit something simple, but a little bit in the strategy space about there's sort of four, vehicles, swim lanes, I call them, of wealth when it comes to, our property investing. And many of us, some of us can take advantage of all of them. Some of us can take advantage of some of them. What do they look like? Who do they suit? And we've got to make sure we have those strategies in our minds as we roll forward as property investors and making sure we get it done. Let me have a bit of a look at this. Let me see. A little bit of a blank screen here, but I'll fix up this one hopefully in just a moment. We'll see how we go. Let's see. But yeah, listen, the four swim lanes of wealth will pop up soon on the screen if we get this right. There we go. All right, let's see how we go. So, the idea that there's not one vehicle of wealth, there's not one swim lane of wealth when it comes to building our portfolios, building our wealth, creating income, creating capital growth in our portfolios in the world of investing. And I want to take you through those for today. So let's have a bit of a look at what this might look like. I'll do a little bit of a bit of a drawing here. I mean, it's not a very even swim lane thing. So number one, the easiest, most common creation of wealth in Australia right now, most Australians have over 70% of their wealth in this asset. What do you guys reckon it is? Chuck it in the chat for me. This should be an easy one to nail. Probably the first one. Over 70% of Australians. Morning, Laura. Quick shout out to everyone who's here. Paul, James, Nick and Christopher, Margaret and Ben, Laura, Alison. Hey, good morning. Good to see you guys. Super. Yeah, Lauren, that one's there as well. We'll call that one number two. We'll call that the accidental wealth for most average Aussies. But what's the number one where people store 70%, according to the stats, 70% of their wealth inefficiently, by the way, All right. Well, it's their home, their principal place of residence, their PPR. So their home, by default, we're taught, whether it's the way to go or not. I don't believe it's the only way, but it's certainly useful as a platform, as a base to launch our investing from. Our principal place of residence, Nick's on it, PPR. For most Australians, we buy a home, and then what we believe is that's how we're going to get rich, or something like that. And, unfortunately, that's not the case. People, work for 30, 40 years, and they might, have a debt on this home. Let's say, I don't know, call it 500K. You don't get much for 500K these days, but, in 30 years' time, it's zero debt. And what's the income on that property? What's the cash flow on that property? A zero, okay? And unfortunately, for a lot of Australians, this is we realise it too late. But you guys are on this. You guys are all over this in mentoring. We know that the principal place of residence, its major value, its creme de la creme value is capital gains tax free. Now, that's all good and well if you go ahead and sell that property, okay? But at some point in the future, and usually there's a downsizing of people's wealth, not people's wealth, but people's living conditions between the ages of 65 and 75, okay? Now, what do we got? Over 4,500 clients who have been through our investing programs and still in our investing programs. I think if I check in Facebook, there's 3,100 of you that are still active in our investing program. So that's pretty good. Over the 18 years we've been coaching people, quite a high retention and activity rate for our investors. But between the ages of 65 and 75, there will be a downsize moment. There will be a disposal moment on your principal place of residence. Now, the thing is, with this, let's say we did start out with a $500,000 property when we first bought this property, and let's say we're 30 at this stage and we've got, call it 35 years of owning this real estate. In my mind, there should be a strategy that the upside, the number of times you upgrade your principal place of residence to make the most out of this capital gains tax-free value should be between 2 or 3. Now, an upgrade is sell and buy in a better location, sell where you are and buy in a better location, or maximize the value of the property in situ. Okay, so if you bought an older property and now it's time to knock it down and build something bigger and better, maximize the capital gains tax-free value. So 1, 2, and maybe, 55, 3. Because at some point, you want that property to be the most value capital gains tax-free in the future. Now, somebody will 99% of the time downsize the PPR and then change the principal place of residence to somewhere else. And you want that to be as efficient, tax-free cost as possible. So number one wealth swim lane is the PPR, principal place of residence, okay? That's a goodie, and you can create great wealth in that swim lane, okay? Which is fantastic. Nothing wrong with that swim lane. The challenge is it has no income. There's zero income for 35 years, team. Zero income, zero tax deductions. All right, let's have a look at that. All right, the accidental wealth, and I wouldn't even call it wealth, to be honest. Most Aussies end up with 2/5 of bugger all. That's a technical term in this one, and you guys mentioned it before. It's your super. Okay, your super. Now, a few of you guys said, oh, well, okay, this is where we're at. Again, you might start, I don't know, the average Aussie might really get serious about a career and working at age 25. And let's hope you can stay productive, a choice of productivity to 65-ish, right? So that is a 40-year term, 40 years, gang, of creating super. The challenge is, this is the challenge, it's pretty hideous. The average male retires with 125 in their super, and ladies, it's less than 60. Check that out, all right? You work 40 years and you end up with 2/5 of all. You know, beep. That was it beeping out right there. So, listen, we've got to do better with that one, of course. Now, there's some advantages there. You guys know the advantages here. Well, you should know the advantages here. Each individual can have $1.4 million worth of assets in their super, tax-free. Tax-free. So then the thing is, the gap, the wealth gap between the average and what you can have is massive. So you've got to have a plan for that one, right? You've got to have a plan for that one. What are you going to do? You can contribute up to $27,500 a year. How do you get more money into here? Well, there's some great strategies. There's some great investment concepts in there. But that is a vehicle for wealth. That's a vehicle for wealth. And those two, it's a terrible number. You're dead bloody right, Alison and Lauren. It's the most hideous thing. Now, there's some great strategies. And for all of you guys listening in the mentoring program right now, make sure you come to this Monday's mentoring night, because we're going to have some amazing conversations with Andy Fenton around, he's a financial planner and a wealth creation expert when it comes to the stock market and those things as well. And he's going to chat about how we can maximize some of these things with our super. So make sure you get to that night, team. All right. So super, it's a vehicle. All right. So these are the two kind of accidental vehicles, right? They're kind of like, they're kind of almost, I don't know, not enforced, but they're kind of, we do them, but accidentally. Okay. Someone broke the internet. You're dead right, Jeff. But there you go. It happens to everyone, even Facebook. Hey, there you go. So, we've got these ones, team. We've got some things that we need to do around our home, our principal place of residence, and super. And you guys have heard this before. It's nothing new, but it's always good to really sink this in, right? Now, the third vehicle of wealth is you, all right? The person, you. And a few of you guys were saying wages and stuff like that. Yeah. Let's say, let's do this quick calculation up here. If you could contribute 27,500, 27.5 times 40 is 1.1 mil. Okay. So that's not including the returns on it and stuff like that over 40 years. But if you could contribute the 27.5 into super every year, that's what it would look like. Okay. So there we go. Right. So think about this. What are we good for? Well, our wage, our income over the next, call it 40 years. Okay. Our next 40 years, let's say at age 25, let's say on average, and I think I saw some stats the other day, but I'll round it out. On average, our earning potential, the average earning potential is something like $82,000, like consistently. If you sort of say the back end of the race is a bit more and the front end is a bit less. So let's just call it, let's just call it $80,000 a year. Times that by 40 years, that's $3.2 million. All right? That's $3.2 million over a 40-year period, team. Okay, age 25 to 65. What are we going to do with that money? Can we take a portion of it and, as you guys are already doing, invest it into something that's going to be there at the end, because money, if you can create the money, that's what you're doing with your wage, your skills, your knowledge, your exchange time for money. Nothing wrong with that as long as you turn it into something. So if we're exchanging and creating assets that in the future create cash flow, in the short term get us some tax deductions, and in the future get some growth, then that's part of this wealth swim lane, this transformation of what we're doing, right? As we go, your wage, your earning potential needs to turn into something. And the greatest tool in our toolkit, ladies and gents, team, gang, is leverage. Okay? Leverage. Lending some money, and cheap money, inexpensive money. Okay? There is more money in distribution now on the planet that every single human on the planet could have $1 million tomorrow, and there'd be still some left over. All right? There's so much dollars and cents looking to go to work, and your job is to attract some of that money and put it into some assets that will go to work, that will add some value to your life and someone else's life. The more value you add to someone's life, the more wealth and cash flow you can create. And that's what real estate does. Real estate does that. Real estate creates jobs. Real estate creates places to live, et cetera, et cetera. I'm a big fan. Others would argue different, but, you know, I don't listen to them because I've got no interest in their opinion, to be honest. Be careful of those who you listen to as you roll down this super freeway called life. All right, there you go. So there's the three swim lanes. There's your super up here. There's your super, swimming nice and fast, going great. You know, here's you. You know, we're creating dollars and then turning it into assets. Happy days. That's part of the plan. These ones over here are quite efficient. Prince Place Residence, your super. What's the little sneaky one on the outside over here? And what's the last one? It might be a little bit of a tricky one, team. But chuck it in the chat if you think you know what it is. What do you think the last one might be that many use to create wealth in Australia? I'll let you know. I'll quickly do it for you. There's business. Business. Some of us might be PAYG. Some of us might own a part-time business, a bit of a side hustle. We might have a full-time business. It's a full hustle, whatever that might be. Business, many Australians have businesses, and they can be very efficient for creating wealth, okay? Couple of the things that I love about business, and, you know, let's say over time, you have some advantages in business. You can have some expenses run in your life, pre-tax dollars. E.g., let's just do some simple ones. You can pay for your mobile phone, your electricity, your computers, and your car. If you run a business, even a side hustle business, if you create some income, you can get some efficiency in some expenses in your life. Nothing wrong with that. Create a little bit more income, claim a few expenses. I think that's a great way to do it. Or go flat out and get right into business, and there's some other values in there. One of the great little opportunities in business is a capital gains tax-free ability to make a sale of a business or a property you run your business from into the future for $2 million tax-free. There's a few rules to tick. There's a few boxes to tick. But team, that's your sort of 4 swim lanes. Business over here. There's your 4 swim lanes for our wealth creation journey. Some of you guys might be using all of them. Some of you might be using only, a couple of them. Perfectly fine. Nothing wrong with that. For most of us, we should be at least using 3. Okay? 3 of those swim lanes as we go. So hopefully that makes sense. There's a few rules to tick. You're dead right, Michelle. And you need a good accountant / financial planner to make sure you sort those out as you roll along. But make sure you have a strategy to achieve that outcome as you go. But there you go, ladies and gents, team, gang. Thought we'd just do a little sort of circle round on the theory today. We all kind of know it, but it's always good to remember, good to be reminded that we need to keep our eye on the prize. And there's 4 swim lanes, 4 vehicles of wealth, 4 ways, 4 things we can be working on. Maybe you can't borrow in your personal name right now. Well, what's going on with the other 3? What's happening with the other 3? Are you turning those into vehicles of wealth for yourself into the future? So there you go. Wealth Coffee Chat done for Wednesday, the 6th of October. Hope you guys are awesome and well. I'll be kicking it off at 8:05 Queensland time, which will be 9:05 on average everywhere else, and then some weird